For the past year, the stock market has been riding a relentless wave of capital, driven almost entirely by artificial intelligence and the semiconductor companies that power it. But we are seeing the first signs of exhaustion. Look at Micron, a titan in the chip industry. In less than a month, its stock price dropped 30%, wiping out billions in market cap. Analysts are now warning of a capex bubble. The massive infrastructure spending that fueled the AI boom is hitting a ceiling, and when those budgets are inevitably slashed, the market's primary engine will stall. When that happens, the trillions of dollars currently concentrated in semiconductors will rotate out. This capital won't just disappear, it will begin an urgent, high-pressure search for a new home with similar growth potential. Because blockchain is increasingly serving as the settlement and management layer for AI operations, digital assets are the most direct technical successor to the semiconductor boom. With the extreme leverage of previous years now flushed out, the sector is positioned to absorb the overflow from the cooling tech market. The largest players on Wall Street are already bracing for this transition. Larry Fink, the CEO of BlackRock, has explicitly stated he is bullish on the market over the next 12 months, signaling that the institutional pipes are finally ready to handle a massive influx of capital. But there is a bottleneck. While the financial sector is ready to facilitate this rotation, a legislative wall in Washington is currently preventing that capital from flowing into the U.S. economy. The path forward for the entire American digital asset industry is currently blocked by a market structure bill called the Clarity Act, which remains stalled in the United States Congress. Much of this gridlock is driven by the lobbying arms of the nation's largest banks. They recognize that if stablecoins are regulated and offer competitive yields, customers will likely move their deposits out of traditional savings accounts and into digital dollars. This opposition ignores a critical benefit for the broader economy. This legislation would provide over 4,000 smaller community and regional banks the legal framework they need to offer these high-yield digital products, allowing them to compete with the banking giants for the first time. Despite these stakes, the bill is trapped in partisan maneuvering. Debates over adding government ethics provisions have stalled progress, making it nearly impossible to reach the 60 votes required for the Senate to act. The result is a stalemate where legacy banking interests and political infighting are successfully paralyzing the deployment of the next generation of financial infrastructure. This delay is more than a missed opportunity. It's an emergency. We are seeing a rapid convergence where artificial intelligence agents are becoming the primary users of financial systems. AI agents execute thousands of microtransactions autonomously. They need an instant global payment rail, something legacy banking cannot provide. Visa projects this shift toward autonomous payments will push trillions in volume onto blockchain rails, making stablecoins the essential settlement layer for the AI economy. Institutional capital is indifferent to borders. It will migrate wherever the regulatory environment is most efficient. Japan has recognized this opening. While Washington remains gridlocked, Tokyo is aggressively paving a regulatory highway to attract the global firms and capital that the U.S. is currently ignoring. Their strategy includes massive tax incentives. Japan is slashing the capital gains tax on digital assets from 50% to 20%, making it one of the most attractive jurisdictions in the world for tech investors. The integration is already deep. Japan is launching yen-backed stablecoins for institutional collateral, while simultaneously tokenizing major stocks to be traded directly on the blockchain. While U.S. lawmakers argue over ethics clauses, a top 5 global economy is actively building the specific technical and legal tools required to house the world's next great capital rotation. We are looking at a market on the brink. There is a massive volume of pent-up capital sitting behind a legislative dam, waiting for the signal to deploy. Dozens of American companies have their platforms ready, their partnerships signed, and their technical infrastructure fully tested. These firms are waiting for the U.S. Senate to pass the Clarity Bill. They need a single legislative yes before they can pull the trigger on a massive wave of domestic hiring and infrastructure builds. But the clock is ticking. What happens if the rotation out of semiconductor stocks hits its peak before Congress manages to act? That liquidity will not wait for a vote count. It will flow overseas, bypassing the U.S. entirely to plug into Japan's tax-optimized and regulated digital economy. This represents a systemic shift. When the rails for the next generation of finance are built outside of American jurisdiction, it erodes the global dominance of the dollar and puts immense long-term pressure on the U.S. Treasury. By failing to act, the U.S. is surrendering the underlying payment protocols and the vast tax revenue that will be generated by the AI-driven economy. Every day of inaction in Washington is another day that the United States actively hands its status as the world's financial epicenter to nations that are actually prepared for the future.